Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 338 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about stock market valuation, and specifically, is the stock market overvalued? Right? You hear a lot of buzz about this, and you hear a lot of buzz about this in any bull market, but we're specifically hearing a lot of buzz about this right now, and especially with inflation increasing. Could we see a crash? All these different types of things. I'm going to cover them all in today's episode, but I'm going to focus on the idea of stock market valuation and whether or not it even matters anymore. So stick around for a discussion of all that and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, let me just tell you, now, if you haven't spent a lot of time in it, and when I say haven't spent a lot of time, I mean you haven't spent years in it. You haven't spent a bear market in it, that you've only been in the stock market for a short period of time. And even if you've been in it for a while, you may need this reminder that the stock market is a crazy place, right? And it's specifically a crazy place in the short term, right? But sometimes you can also look over the long term and go, dang, it's been pretty crazy in the long term too. Right. And that's something I think you can do right now. Not looking at it and being like, this is completely illogical. Right. But looking at it and going, wow, so much has been created as far as wealth over the past year, 5 years, 10 years. Like, how do we even look at this as something that is normal? How do we look at this as something that, should be occurring? Right. And when you see all of this wealth creation, you see all of these great returns that we've had in the recent past, you can't help but ask yourself, where do the returns come from, and are they warranted? Are they too high, right? So just for instance, in the past year, the S&P 500 has increased by 1,091 points just in the past year, right? And that is equivalent to just over 30%. So 30% in a year, if you don't know long-term market history, is an outrageous return, is a fantastic return, right? Getting 30% in a year is an amazing return. I'd love to get 30% every year. Now, this is not likely that we will ever get 30% every year. I'd say it's just not going to happen, right? But ultimately, we'll take it when we can get it. Then you look over the last 5 years, the S&P 500 has over doubled. 5 years ago, the S&P 500 was 2,519 points lower than it is today from its 4,700 mark. So that is 115.45% increase over the past 5 years. Right? So you would have over doubled your money if you just put money in the S&P 500 and left it there for 5 years. Right? These are amazing returns, right? So on an average annual basis, you're talking over 20% there. On a compounded basis, you're still pushing 20% there. So ultimately, we're talking fantastic returns, especially considering that the long-term historical average has been around 10% with dividends reinvested for the S&P 500. All right, so it brings about the natural question of whether or not the S&P 500 or the stock market as a whole is overvalued, right? And you would naturally go to some of your valuation ratios and some of your valuation metrics to kind of get a better idea, because just because price increases doesn't mean that something is overvalued, or just because price decreases doesn't mean that something is undervalued, right? Because the value may just follow where the value comes from. It may just follow the fundamentals of the market or the fundamentals of the firms that make up the market. And so you have to go and look at the price relative to those fundamentals. You have to look at the price relative to the earnings, the price relative to the book value of assets, the price relative to the sales, and see where it all lands. So the longest running metric that we can look at is the price to earnings ratio for the S&P 500. And the current price to earnings ratio is 29.61. That means for every dollar of per share earnings that the S&P 500 is creating, you're paying $29.61 for that. Okay. Now, just to give you a better idea, over the long term, over the past 100 plus years, the average has been somewhere around 16. Right, it's been somewhere around paying $16 for $1 of per share earnings, with the median being just below 15. The max that we saw on the S&P 500 PE ratio was during the financial crisis, and that's because when prices plunge, right, and then so do earnings. This was as earnings were at a point where they were extremely low, right? If you have very low per share earnings, you have companies going bankrupt, things like that, then you're likely to have a very high PE, right? But in another sense, a very high PE like we see now can be due to speculation. It can be due to a market being overvalued. We saw this back in the dot-com bubble, right? We saw PE for the S&P 500 get up around 40, a little above 40, and then came back down very hard. And then we went into the financial crisis, peaked again, and then we've seen it climbing back up as the market has climbed up over the past several years. Now, this is not to say that there are not good earnings in the S&P 500. Everybody says, fundamentals are strong, earnings are strong, all these types of things, right? But are we paying too much for those earnings? Again, I'm not passing judgment just yet. I'm just saying relative to long-term averages, we're paying a lot more than we have in the past. Now, what about the price to book value, right? So that's saying the price of a company, divided by the per share assets of that company that are on their books, right? That is valued at the book value on the balance sheet, right? And we're sitting right now at 4.85 price to book, which is the highest that it's been since 2000 or 2001. I'd say 2000. This graph doesn't tell me perfectly, but I would say since the beginning of 2000 here, where it was right around 5. And so this is telling us that relative to book value, we're very expensive at this point relative to what we have been in the past 20 years. Then what about sales? Everybody likes to say, well, what about price to sales? Because they say, okay, don't just look at the bottom line, look at the top line too, right? And I get it. If a company is going to create some top line revenue, that doesn't always mean that it will turn into earnings, because a lot of things come out before earnings. But you even look at price to sales. The price to sales for the S&P 500 right now is 3.21. Long-term average is 1.63. And we haven't been anywhere near 3.21 in the last 20 years, right? In the last 20 years, we've hovered in the upper ones. We broke into the low twos around 2017, and then we've stayed in the twos until the last year or so, when we've broken into the threes on a price to sales basis, right? So that all, as the market is going up, can be attributed to the fact that valuations are increasing. We're paying more for fundamentals than we have in the past. And then the question becomes, is that a bad thing, right? Is it something that we need to be extremely worried about? The short answer, in my opinion, is no. And here's why. Because markets get overvalued and markets get undervalued from time to time, right? Obviously, we would love to take advantage of the undervaluation, and we'd like to, take some off the table with the overvaluation. But there's this old saying that says that markets can keep going up longer than you can stay liquid, that longer than you can stay solvent, right? And that's meaning if you're going to bet against a market, right? So this is meaning for people who take short positions, right? They're betting on the market to go down, right? And maybe the market has every fundamental reason to go down, right? But markets can stay going upward far longer than you can stay solvent in a position. So all this is teaching us is that sometimes it's not smart to fight what's going on in the market. And if you're fighting what's going on in the market right now, you're fighting some very, very strong powers on the other side, right? Because my, idea, my thoughts when I'm looking at market valuations, I think they have a lot to do with the amount of money available to investors, right? The amount of money available in the market right now, because you look around and money's being poured in from everywhere. right? Not to mention you're seeing inflation, so the prices of goods and services is increasing. And if that happens, then what are firms able to do? Firms are able to increase the prices of their goods and services for the consumer. Right. Now, this, may not have a huge net effect after wages rise and all these other things. Right. But ultimately, that's going to have a positive impact on earnings. It's going to have a positive impact on sales, positive impact on asset values. Right. And so we will end up seeing that prices will rise. Now, how much will prices rise relative to those fundamentals? I think that's the big question. Okay. But ultimately, I don't think we can just make decisions based on valuation, right? I think any good investor would tell you that making a decision purely based on one of these valuation metrics is not a good idea. And I especially think when it comes to an overall index like the S&P 500 that has provided great returns over a long period of time, we can't look at these ratios or these metrics and go, hey, these mean do invest or don't invest, right? They just tell us some relative number that we can use for long-term comparisons, but they do not tell us whether we can make investment decisions one way or the other, right? So we look at these numbers and we say, oh, they're all pointing towards an overvalued market. That's fine, right? But how long have they been pointing towards an overvalued market? Well, the answer is for longer than we would like to admit. Right, a lot of these metrics have continued upward during the bull market of the 2010s. Right, we've seen these metrics continue to creep higher and higher and higher. I was an investment advisor representative in 2017 and 2018. And after Donald Trump got in office, the market took a little spill like the next day or so, but then the market just roared afterwards, right? And everybody kept saying, they wanted to, get out or take some money off the table before the inevitable dip, the inevitable crash that was going to happen, right? And I just kept telling them, hey, the likelihood that you can time what that crash is actually going to look like, when it's going to occur, how large it's going to be, the likelihood that you can time that and not come out on the other side a loser is very, very low, right? Most of the time when we try to time crashes in major market indexes, then we end up missing, right? Huge investors end up missing. Right, there are several investors that are very well known for being able to spot a crisis coming. But what you don't see from those investors afterwards is the fact that the returns that they make for their investors aren't very great, right? Because they're constantly trying to look for the crisis. And ultimately, crises are few and far between. Now, if you can hit very big if you're right? But ultimately, how often are you going to be right? And you may say, I was right, but I was early, right? I was right that the market was going to crash, but I sold really early, or I took a short position really early. Well, what's the difference between being early and being wrong? There is no difference, right? It's like, you buy a stock that you're saying, oh, this stock is, undervalued, right? And you buy it, and let's say it continues to go down. And maybe you even pick up some more as it continues to go down over the next few years, and you make negative returns. But then all of a sudden it blows up after a few years, and you make pretty substantial returns from the bottom. And you go, I knew that thing was undervalued. Well, you may have missed out on a lot of returns somewhere else because your timing was off, because you did not time the transaction well. And I'm not sitting here saying that we need to try to be good timers of the market. That's not prudent investment theory. That's not prudent ways to invest. The prudent way to invest ultimately, especially if we're going to buy indexes, is to do so and continue to buy and buy and buy and never sell, right? Don't be a seller unless you are using the money for some purpose, right? Ultimately, just continue to buy and buy and buy and buy, okay? The problem is that a lot of people, they don't have a portfolio that suits them properly, right? And we'll get back to this idea of, are markets overvalued and should we be worried? But people have portfolios that just don't meet their needs, don't meet their particular preferences, right? And then ultimately they look around and they go, oh, this is way overvalued. This is too good to be true. I'm going to get out and all these types of things. And they freak out because they can't sleep at night with the allocation that they have, which I think is a big issue. And advisors need to take heed to that and pay attention to their clients and what they are suggesting their clients actually invest in. But nonetheless, right? Do we really need to worry about this? Do we need to worry about the fact that market valuations are higher than they have ever been in our major indexes? My short answer is no. Now, what could this potentially mean? All right, this could mean some things, right? This could mean that as we move forward, that we are going to see lower returns. That wouldn't be surprising, right? It's not going to be surprising if you come off of a 5-year period where you're averaging almost 20% a year or around 20% a year in returns. It's not going to be surprising if you come off of that stretch and then, the market cools off for a little while. That would not be a surprising result, right? Now, does that mean that there must be a crash? No, that does not mean at all that there must be a crash. Right? That just means that there may not be as high returns. Yes, could there be times where we have some substantial pullback? Sure. People have argued that the 10% correction has turned into the 5% correction, right? We're getting more and more finicky when the market just dips a little. Since we've seen such a big bull market, we just buy when the market dips a little. No, I think 10% corrections can still occur, and I think they will. But the question of when, the question of how often, the question of how that's going to impact our returns is out of our control. We do not know. Okay. Now, because we may find lower returns in the near future, does that mean we stop investing in the major market indexes that we know and love, like the S&P 500? Absolutely not. Right? But what it may mean is that you need to pay more attention to your asset allocation. You need to pay more attention to your diversification, right? You need to make sure that all that is in the right place, right? Because if you, let's say, have lagging returns in the S&P 500, you may have some international markets that outperform. And if you're properly diversified and you have international allocation in your portfolio, then that may be a good place to be. Yes, it's hard to look at the bond market and go, how are bond prices going to fare? But what we're likely to see before the stock market does anything that's absolutely crazy to the downside is, these rates are going to start rising likely next year. Right? And as rates rise, then what do we know about bond prices? They decrease. But as rates rise, right? And so that means that bond yields are going to be higher, and so they're going to be more attractive to investors. And so that may be a place that you can make some more money, in the coming years. But it's going to be weird as rates rise because the price of the bonds will fall. So it's just going to be interesting to see. But ultimately, I don't think this is necessarily a sign of a crash or a sign of something dramatic happening, right? The dramatic things that happen very rarely happen just because things are overheated, right? Yes, we saw the tech boom of the early 2000s and then the ultimate bust of that tech bubble, late 90s, early 2000s, right? We saw the ultimate bust, and that was very speculation driven. And do not get me wrong, we have a market right now that has a ton of speculation within it, right? We have speculation in cryptocurrencies and NFTs and people who don't know how to buy real estate trying to buy real estate, right? We have people buying triple levered ETFs. All this stuff is happening, right? That is kind of our backdrop. But at the same time, all of those things are happening. You also have a bunch of very disciplined, very set in their ways investors that are doing one thing and one thing only, and that is dollar cost averaging into major index funds, right? And in doing so, what's that going to do? If they're just buying and they don't care about valuation, which is true, right, of us who dollar cost average into our portfolios, if you don't care about valuation, you're just going to buy and buy and buy and buy over time. What's that naturally going to do to our valuations of these major indexes? It's going to increase them, right? Because now not all the movement that we see is based on just fundamental analysis. Now you have individuals who are buying who do not care what the price is, who do not care what the fundamentals say. They just care that they're just going to keep buying and buying and buying to get good long-term returns. Right, so that could be a big reason why we see higher valuation metrics, and maybe we need to get used to them. Right, maybe that is the case. But even though all those things are true, even though this may be a new normal for valuation, we also have to be cautious, right? And especially we have to be cautious if we're buying individual stocks, right? Because this market PE or the market price to sales is coming from the culmination of all the individual company price to earnings and price to sales, right? And ultimately, those companies are going to have to vouch for themselves in one way or the other, right? Those companies are going to have to show that they are worth the valuation that the market is bringing up. There have been several companies in the past year or so that we have seen blow up. Their stocks have blown up, and then their stocks have subsequently fallen off the face of the earth. So I'll give you a couple of what I think are pretty good examples, right? So there's the stock of Zoom, right? Zoom was the darling of the coronavirus pandemic because everybody went to working on Zoom and meeting on Zoom, and all the classes were held via Zoom, whatever, right? But we have seen from their peak nearly a 50% decline. I think the decline actually might be more than that. Yeah, 53% decline from their peak. Now, does this mean that Zoom Video is not a good company? Not necessarily, right? But what this may mean is that investors just got ahead of themselves, right? If you take it all the way back to January the 3rd of 2020, and you just take the returns from that date to its peak, right? And its peak occurred on October 16th of 2020. The stock made 730% returns over that, 9.5 month period, right? And so you can't tell me that those types of returns are warranted. And if you take it from January 3rd to now, January 3rd of 2020 to now, you still would have made 293%, even though the stock is down more than half from that point. So what's my point? My point is that valuations can matter, right? Valuations can get overstretched to the upside, and especially once vaccines were coming out and things were being done to put a damper on the pandemic, then Zoom Video just continued to fall. There are other companies that have been darlings of the pandemic that have again fallen off the face of the earth in a pretty dramatic way. Another one that comes to mind, I know these are both Z names, but Zillow. Right? Zillow was a company that, a bunch of people were using. It's an online company. The housing market was hot. The housing market still is hot, right? So a bunch of people use Zillow. Zillow peaked back in February of this year, and since February is down over 69% from its high. But again, right, if we just stretch things out just a little bit, right, and let's say you went back to January 3rd of 2020 till today, you still would have made 40% in Zillow, right? Just because we've seen this huge gouge does not mean that you wouldn't have made money. It just means that maybe the valuation got ahead of itself, right? So we need to pay attention if we're investing in individual companies at the fact that the valuations of some of these companies can get very overbought very quickly, and it can cause some harm to your portfolio if you are investing in things that are extremely overvalued. But on the other hand, you have stocks that just go up and just continue going up. I don't think I need to tell anybody the Tesla story, right? The returns by themselves are just outrageous, but we can talk about them for a moment, right? If you just look back to a year ago, what type of returns would be made on Tesla in a year? 138%. And you may say, oh, well, that's not as much as I thought. Okay, well, a year ago only takes you back to November of 2020. Well, let's back that up all the way to January of 2020, right? And if I back that up to January, what do I see? From January 3rd, 2020 to today, right, Tesla stock has increased 1,090%. And it hasn't showed any signs of stopping, right? It just continues going up and up. Yes, there have been big dips and big bounces, but nonetheless, it just keeps going up and up and up. And you've seen over 1,000% returns over the past 2 years. That's crazy, right? So in this case, if you sold 300% ago, yes, you may have made fantastic gains, but you miss out on a lot of the upside, right? So it's hard to tell if valuation matters, because these are both companies that we can look at. These are all companies that we can look at and say the valuation metrics were just off the charts, right? The stock was off the charts. It was blowing up, right? But some have fallen off very substantially. Some continue upwards, right? But you have to be able to be prudent in your investing and prudent enough to know the difference if you are buying individual stocks. Know the story, know what drives the stock upward or downward, and understand that if certain things happen, then you can be on the short end. Look, again, if you would have bought all of these companies prior to their blow up in price, all of them would have made you very good amounts of money. But since then, there have been some very different movements in the way that these companies' stocks have done. So, nonetheless, what am I getting to? What I'm getting to is this. Valuation, it matters, right? Valuation is important. There's a reason that it's taught in every business school everywhere. And there are people who argue that it shouldn't be taught in every business school everywhere. But there's a reason that it is because it does matter. Now, is it taught in the perfect way? I don't think so, right? But that does not mean that it should not be taught. That does not mean it should not be taken into account. And it definitely doesn't mean that we should just set aside some of these traditional valuation metrics. It just may mean that these valuation metrics aren't what we thought of them as 10 years ago, 20 years ago, right? The nature of companies has changed, right? The nature of business has changed, right? But if there's something that I've learned about investing, and there's something I just want to leave you with today, is that anytime you hear somebody say that it's going to be different this time or it's different this time, it isn't, right? The market does. I did a whole episode on this talking about how the market does not care. The market does not care what you think. The market doesn't care what your preconceived notions are. The market is here just to show you value. It's just to show you what the price of something is based on a bunch of different buyers and sellers at any given time. But ultimately, it does not care, and it is going to do what it does. And typically, it is going to be mean reverting. Right? Jack Bogle talks a lot about this in the Little Book of Common Sense Investing. He talks about mean reversion of returns, mean reversion of these major indexes and their valuation metrics. And it's true. They do mean revert, right? Historically, they do mean revert. So could this mean that we see lower returns? Sure, it could mean that we see lower returns. Could it even mean that we see a very staunch crash in a short term? Possibly, right? Now, something's going to have to set that crash off, but it could definitely occur. But does it mean that we stop investing? No, right? You and I need to keep putting money away. We need to keep just plugging away at our investing because if you were investing in the 2000s, I'm talking 2000 to 2009 or 2010. Ultimately, the money that you invested at the year 2000 didn't really make any money to 2010. Right? Yes, you invested through some lows where you could have made some money, right? But that money that you initially invested didn't make much money at all, right? So you've seen dead periods in the market. You've seen periods of basically no returns, right? And I'm not saying we'll see no returns, but we may see far more muted returns than we have seen in the recent past. And I'm interested to see what this market does, especially if some type of downturn or crash or correction pushes some of the retail money out and pushes out some of the individuals who are just trying to trade in the short term. And we're just stuck with us long-term investors who are trying to make long-term returns. Yes, it'd be a more boring market, but ultimately, boring markets are what we like, right? Markets that are more predictable is what we like. So again, valuation matters, but it should not change your investing strategy. It should not change the way that you choose to look at markets. Yes, you may choose to invest in different stocks if you're buying individual companies, when a market is white hot relative to a market being pretty cold. You may invest in different ways based on your strategy even, right? If you're a growth investor, then you're used to high valuation metrics. If you're a value investor, then you're used to lower valuation metrics, and you know what comes along with that. But again, this does not mean that we should be different investors just because of valuation. That would be foolish, and it has never turned out that trying to sell at some of these valuation highs turns into profitable trades. We will be bad at timing. We are, as humans, bad at timing. Just when we think things are going to be, horrible, they just continue upward in the kind of pace that you just couldn't imagine, right? Just go back to last year after the market crashed. People never thought that we would be seeing the returns that we have on the other side, but we absolutely are, right? So stay invested, keep your strategy the way it is, take heed to valuation, right? But don't let it change who you are as an investor, because ultimately stocks can continue going up, and you need to be a beneficiary of that, not somebody standing on the sidelines saying, I wish I was in there. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.